All right, let's see portfolio analysis. All right, number one, gold is uncorrelated to other investment classes. This is important. In a portfolio, you want to get an asset which is not correlated to other assets. So when it is not correlated, it allows for diversification. Portfolios are about diversifying and enhancing the return while reducing the overall volatility and therefore the overall risk. You can accomplish that by buying more and more uncorrelated assets or assets uncorrelated to each other. And if you are able to add an uncorrelated asset to the portfolio, it will enhance your risk-return profile. It's actually, of course, negatively correlated to currencies. Of course, if currencies go up, gold goes down, and vice versa. So when you have some portfolios that will have currencies or denominated in currencies, gold is a very good diversifier of portfolio. Excellent portfolio diversification, it is the result. And as I already mentioned, it improves the portfolio risk-return profile. Now, here is a key. Scholarly, as in academic research by professors which run extensive correlations, suggests anywhere, again, different types of research suggest that 5, 10 to 20% is optimal from a portfolio point of view, from a diversification point of view. When scholarly research focuses on portfolio analysis, they do not factor in commodity bull markets and commodity bear markets. So, from a portfolio point of view, it will be optimal to have 10% if you don't have a commodity bull market. But if you have a commodity bull market, you'd better add some more. If you expect currency crisis, you'd better add some more. If you expect financial crisis, you'd better add some more. So, if the more reasons you have, the higher should be the portion of gold in your overall portfolio. All right, so turns out that up until, well, let's say 5 or 6 years ago, gold has been considered to be riskier than stocks. Well, now a lot of new research comes back and says, well, some of the old analyses were incorrect. They were not produced well. They didn't factor in a bunch of other factors. So they didn't hold constant a number of things, and now when we get to hold those things constant, as they should have been done in the first place, the answer is that gold is actually not riskier than stocks. Because there is this common urban legend that gold is riskier and stocks are relatively safer, which we find out is not true. Well, in a commodity bull markets, quite the opposite is true. Gold is astonishingly safe and stocks are remarkably risky. So the risk changes definitely whether in a commodity bull market or in a commodity bear market. All right, so gold is highly correlated with commodities in a boom. Of course, if wheat goes up and crude oil goes up, gold will go up. So in this particular case, gold acts as a superb inflation hedge. I mean, no news here, but it is part. However, when you are getting in a bust, in a recession, in a depression, an example will be 1973, well, 1974 oil crisis, you had an economic recession, global. Back then, gold did far better than any other asset in the world. All right? 79 in 1980. The gold did extremely good. Only silver did better, you know, the question of silver. So, again, gold is doing well and on par when it comes to the upcycle. But when the economy falls into a recession, then gold beats everyone else except for possibly silver. And finally, gold stocks cannot replace gold bullion. This has to be understood clearly. Now, this is an argument from portfolio analysis. Gold stocks correlate a lot more with the stock market. And gold stocks correlate with gold, but not as much. From a portfolio point of view, if you're going to be diversifying, gold stocks are not a good diversifier, because when the stock market crashes, your gold stocks will crash too, while the gold price will go up. So this is important to understand, that gold stocks are not part of a diversifier. Gold stocks in investing have a completely different version. It's called striking gold, meaning if you have a gold mining company and you think that the gold mining company will be able to find a lot of gold and mine it profitably, it can outperform gold 10 or 20 times. So if gold goes up 10 times, the stock will go up 100 times. But you get only 1 in 10 gold mining companies that do that. You'd better be an extremely good stock picker, or have an inside information and be able to, willing to go against the law. So gold stocks, no good from a portfolio point of view. All right, only gold is the one. Let me see if I have anything else on portfolio. No, so that's on portfolio. So any questions on portfolio?
There are people who invest in gold.
Let's wait for the microphone, sorry. And everyone else will hear you better.
Okay, thank you. There are people that invest in gold that is available physically.
Physically, yes.
Yes.
These are.
How will those people go? The commodity papers go when the stock papers goes down and the gold prices goes up. What will happen with the papers where people invest in commodities like gold?
Papers. What do you mean by papers? Like paper gold, electronic gold?
It is physically gold. There is security for the gold, but they have it on paper because it's more practical.
Okay, okay. Let me allow this at the very end, because I already have like half a slide. It's an important point. I want to elaborate a little bit more, not at this point, because you're asking of how to invest in gold. And I have a slide, and I'm going to get there. So your question will be answered. Let's see, any other questions? All right, let's move on. Behavioral analysis. Well, what you want to buy is not what everyone else is buying. What everyone else is buying, they have already driven up the price sky high. All right? You want to buy something that other people aren't buying. All right? Well, what other peoples are not buying? For example, I don't know anybody buying uranium, and I only have few people that I know are buying gold. When I tell people, hey, I'm investing in gold, well, I invested today in gold. There's a lot today. Guys, I'm not selling gold here. I'm buying gold, all right? When I tell them, they say, what, investing? Why would you do that? I mean, real estate. Everyone tells you got to buy real estate. I mean, real estate. You see, the point is that gold has not been massively bought yet. So gold, number one, is not well understood. Of course, I have found over and over again that, again, the educational and the financial culture, especially for commodities, and specifically for gold, has dramatically deteriorated. One example is simple. You can't find a paragraph on gold in any investment textbook. You have certified financial accountants, and there is not a word about gold. I mean, gold doesn't exist in all of this literature. Well, of course it does, because you can see it, but it's not in the educational. So people have lost their understanding. Well, it takes 2, 3, 4 decades, 3 decades, have lost their understanding of gold. So it is not well understood. You know, a lot of people just say, why should I be even buying gold? All right? Well, that's one reason. That's part of the behavioral analysis. And number two, I mean, these are all together. It's different sides of the same picture. Gold is therefore not widely recommended. Well, these are the types of assets that you guys want to buy. You want to buy something that is not well recommended because people have not already bought it and it is still cheap. When everybody is buying it, you want to be the seller, because when everybody is buying it, the price is high, and you want to be selling at that point. Again, gold is still unloved. People don't love gold. All right, that's just how it is. I mean, that's how it is today. There was a gold bull market, if you remember from the first slide, from 1966 all the way to 1980. Common people began to invest in gold when?
At the wrong time.
Huh?
At the wrong time.
Well, no, in which year particularly?
1980.
1979. So, the gold bull market was in 1966. For 12 years, the prices were going up, and only then people began to get in big time in gold. Well, what about the US stock market, the bull market, the dot-com mania? Everybody knows, right? When did the dot-com mania begin? 97 or so? Well, the bull market in stocks began when? 1982. For 15 years, investors were out of stocks completely. For 15 years, the stock market has gone up big times, 10 times and over. And only then, 15 years later, investors began to buy into technology, dot-coms, and telecoms. Again, in 97, you could have made till 2000 money, no question about it. But the bigger money was made for those who bought in way earlier, in 1982 or in 1990 or 1991. So the earlier you buy, the more you make, but more importantly, the safer is your investment. So that's a general, it's called contrarian investing, contrarian thing. You don't want to simply do in investments what everybody else is doing, okay? I mean, that's just common logic. If everybody bought, then who else is going to buy it to drive the price even higher? You had a question? No. All right, so gold is hard to value. This is another interesting one. CFA stands for Certified Financial Analyst. These are the financial gurus that give you investment advice. Well, they never studied for their certification exam gold, and they're baffled because gold, this ounce does not produce any income. It's not like a factor, like any other stock or like a bond. It doesn't have a cash flow. So, how do you measure an asset which has no cash flow? Well, these guys are baffled. They don't know. They've never studied it. For them, if it doesn't have a cash flow, it probably doesn't have value. Well, if it's scarce, it certainly has value, but they can't tell you what it is. So, these experts are no good and of no help. And, of course, if they do not understand it, they don't recommend it. All right? Next, gold is undervalued. I began this a while ago with gold versus stocks. It is undervalued relative to all financial assets. So, are you going to be buying stocks and bonds or gold? And the answer is certainly stocks and bonds are overvalued and a bad buy. And gold is undervalued and a good buy at this point, meaning in this time frame. 10 years from now, the picture will change. And then, the public doesn't know how to spell gold. This is Bill Murphy from GATA. Again, people don't even see. Why should I even buy gold? So, all of this behavioral analysis, all of these points suggest the one thing, that in general, people have not yet bought into gold as they have in real estate or in stocks. So, there is still a lot of money to be entering that market. That's how it is interpreted. So, the contrarian investor will say, when everyone is buying, I want to be selling because the price is already high. And when no one is buying, I want to be the buyer because I can buy it cheap and I don't have to compete with 5 million other buyers. Well, you guys now got to compete with the Chinese, all right? All right, so any questions on behavioral analysis here? Well, I'm getting, of course, very close to my end. So this is the fifth type of analysis. Again, gold is in a secular uptrend. Secular bull market refers to that bull market which I showed you the 4 cycles, 3 that already completed, and now we're somewhere in the 7th year. It's going to last for another anywhere between 5, 10 to 15. I'm willing to bet for a total of 25 years. So it's easy to bet for another 15 years from here on. Now, gold is rising also against all major currencies. Again, it just happens to be that way. This is a fact. I think I have a chart. I think I have a chart for most of these to show you so that they actually see a picture. But now I'm just trying to make the point. Also, gold is seasonal. This means that different months will present different demand and different buying. And so, when you're seeing a specific month of price of gold fall, don't get scared because, something went wrong. It may be just that there has been a seasonal low demand and naturally the price of gold corrects. Again, another very important property of the gold market is that there have been regular, more or less annual, 15 to 25% regular pullbacks. For a normal investor, this can cause a heart attack. Your gold falls 25% in 2 weeks. Well, it fell like 10%? Last week, 2 weeks ago, right? Well, so that is kind of like, some people get a heart attack and some people get discouraged. Well, you got to understand that 15 to 25 is perfectly normal. It's absolutely regular. So when you see 15 or 20% fall in the price of gold, you actually rush and buy some more. At least that's what we do, all right? And usually these regular pullbacks occur anywhere between every 12 and 24 months. So usually investors run in and there's some speculators and whatnot, and suddenly the price collapses and everybody gets scared. And that's how it works. The point that I'm making is that these are normal. These occur constantly. These should not be surprising to you if you have any gold positions. And if you get a pullback, go and buy some more. All right? So let's see some of the charts that I have. All right, so here's a chart, and you see from 1970 all the way to roughly 80, how the price of gold was roughly 35 and then 42, and then went all the way to 800. So this represents one secular bull market, the secular bull market, which on this picture is represented from 70 to 80. And then you see a secular bear market where gold did nothing and mostly fell in dollar terms all the way to 99 or in 2001. And then for your convenience, I have shaded the last, meaning the current bull market that started in 2001. And you can see what the price of gold is. And you can see these corrections very clearly on this picture. They do occur, but doesn't mean that the bull market is over. This is just an illustration. Take a look at what it looks like. Next was the point that gold price is rising in various currencies. Well, you're seeing it now in, Swiss franc, Japanese yen, US dollar, euro, and British pound. Well, I couldn't find one with, Swedish currency, but if your currency behaves like the euro, just take the euro and see what's going on. Well, it has been marked up against 100. This is in January 2004. You just see that since 2004, it has gone up in practically all major world currencies. Of course, it has been going up even since 2001, but some currencies were a little stronger before that. Since 2004, since 2004, gold is the preferred currency, meaning it rises against all other currencies. A different way of stating is gold has been the strongest of all currencies on international markets. All right? Is that clear? Want to move on? Question?
I would like to ask you about the relation.
Okay. Microphone.
Thank you. I would like to ask you a little bit about the relation between the value of the US dollar and the value of the gold.
The value of what?
Of the US dollar.
And the value. Well, it's strictly negative. It's clear. The dollar falls in value gold doesn't change much its value, so the price of gold in dollar terms will go up. It's an arithmetic, so that is almost 1-to-1. But gold rises also for other reasons above and beyond compensating purely for the weakness in US dollar. Again, how do you measure the weakness in US dollar? Dollar falls against what? Against euro. But the problem is the euro falls against a whole bunch of other things. So, you see, the point is if the dollar is weak, you got to measure it. It is all, you got to say weak against what? So, if it's weak against crude oil, sure, right? If it's weak against euro, but the euro is also weak. Is this point fairly clear? I mean, this is kind of like relativity. I had 3 cars moving, and you know, one is moving to 50 and 60 and 65, and you know, same story. Is this answering your question? All right. Any more questions so far before I move on?
I was just going a small comment. It's not linked because it's linked to the U.S. government, which decided not to link the U.S. dollar to gold prices.
Okay, no, it's not to link the U.S. dollar to link the U.S. dollar to gold. It decided to de-link it in 1971. On August 15th, Richard Nixon had this presidential order where the dollar shall be no more convertible to gold. And from this point on, you see, well, this is, let me try this one. This is 71 here. This is when, right, this point where gold takes off. It's actually gold doesn't take off. Gold stays the same. The dollar is tanking. That's why you're saying this. It's just the dollar fell 10 times. Of course, everything went up 10 or 15 times. Cars, gasoline, wheat, bread, no matter what you take consumer-wise, it all, you know, it went up sky high against the dollar simply because the dollar fell 15 times. Not that gold went up 15 times, all right? Is that relativity clear? All right, so this is the picture about the cyclicality. You see, some months you have distinctly outperformed. So you can see that May is very strong month. And you can also see that February is typically a weak month. You also see that November is typically a weak month, all right? So what you got to understand is that there are months for which gold performs a lot better, and there are other months for which it doesn't. That's because how it works. That's because Indians buy when they buy. I mean, they buy when they're going to be having their marriages and their, you know, marital season and whatnot. So they're going to be buying massive quantities of gold. And then once the marriage season is over, they are, you know, pulling back their demand. So they're not buying in some other months. So some months are felt better, and you should be aware of that. And if, let's say, you see February, price of gold isn't moving, don't get discouraged. That's how it has been, you know, with an average of 37 years. All right? Is this fairly logical? Clear? Makes sense? All right? Now, this is a picture which is in terms gold in terms of euro. And here's an interesting thing. Euro was remarkably stable up until 2005. Like 360 euro was the threshold, and gold couldn't go through. Well, the ECB was, you know, offering massive quantities of sale of gold on the market to be absolutely sure that gold doesn't rise against this price. So they've been trying to suppress it and hold this level. Well, they couldn't hold it much longer, and in late 2005, it ultimately broke out, and you see from 350 went all the way to 550. So the longer you hold it within a specific range, when it breaks out, the more it breaks out, and very fast. So now you see it's been gone to 600, and recently, within a couple of weeks ago, it was like almost 650. So it is, it's called in English, off the chart, right? So it's gone to 650. So you can see literally that from 350 to 650, you get almost 100% return in euro, literally in, what is it, from 06 in roughly 2.5 years, almost 100% in euro. So if your Swedish currency is close to euro, you get more or less the same results in here. And you can also see these pullbacks there on the chart. You know, it moves, pulls back, moves up, pulls back, moves up, pulls back. Again, these are normal technical corrections. That's nothing to be discouraged about. Any questions here? I move on. All right, so this is your question on gold, how to invest. There are very many forms. Number one is gold certificates. You know, someone will issue a gold certificate. Perth Mint issues gold certificates. So you give them the money, they'll give you the certificate. Essentially, they store it for you. UBS, Credit Suisse can do that. So gold certificates are good because they provide that convenience. But it can be that your UBS just goes bankrupt. And then your gold certificate might turn out to be next to worthless. You got to understand that gold certificates, there are two types. It's extremely important. Allocated and segregated accounts and pooled accounts. If it is allocated and segregated, you might not lose your money, but it's more expensive. If it is pooled account, you're just a general creditor of the financial institution. Usually financial institutions that issue gold certificates, usually, not always, issue them as pooled accounts. So when the institution goes bust, your gold evaporates. So there is what's called counterparty risk. The counterparty goes bankrupt. Gold accounts, again, very convenient, very easy to work with, all the good stuff, but the counterparty risk is there. Next, gold storage at bullion banks. That's fairly decent one. You could just, have a bullion bank store it for you. And maybe they will also insure it with Lloyd's. That's another alternative. Again, you incur storage costs. You gotta buy it, you got all this kind of stuff. That's a distinct possibility. Gold mining stocks, certainly not a great alternative with respect to diversification, and they also not provide excellent returns. Some stocks, 10% of stocks, will dramatically outperform gold, but more than 50 or 60% of the stocks will actually not perform well. If you're a good analyst, stock analyst, if you have a good analyst, gold, and you can choose or pick good stocks, then gold stocks are a good choice. Of course, if you're a conservative investor, you will have no more than half of your gold investment in gold stocks. So if your portfolio is having 20% gold, you should have 10 in physical and at most 10 in gold stocks. Well, I personally, full disclosure, don't own any gold stocks whatsoever. About half of what I have, besides my house, is just gold, physical coins. Gold spread betting, this is extremely risky, highly leveraged, and it is not recommended except for professionals. Gold ETFs, they have relatively low cost, greater flexibility, there is little management risk, and they are a decent way to go because they buy and sell like stocks. They provide the convenience. Again, as long as here you have what is called a regulator risk. They will be doing what they're doing, but you're not sure if the regulator will be watching, supervising, and making sure that they actually have the gold that they claim they have. These things do happen. I mean, you guys got to understand that they're claiming all this stuff, but at the end of the day, they didn't have the gold. And when they actually wanted to get your gold, you found it wasn't there. But you fooled yourself or were deluding yourself for 10 years that you actually had gold when in reality it wasn't there. When you wanted to cash out to do your thing, whatever that was, buy a house, finance child's education, I don't know, you realized it wasn't there. So the point for all of these, it is extremely important to understand they all have some sort of a counterparty risk and some sort of regulatory risk, which is what is here is saying is that this gold is actually someone else's liability. Well, the only gold, and that is what gold has been always chosen for thousands of years, is that this particular gold, and of course bars too, which is bullion, in your own possession, is the only type of gold which is nobody else's liability. It is an asset, and you do not depend on anybody else but yourself, possibly to store it safely so that it's not stolen by burglar or being robbed. So, from this point of view, gold bars and gold coins are vastly, and I mean vastly superior, because they eliminate a bunch of risks which you cannot control and which you cannot know beforehand. You can suspect but wouldn't know. And it's a poor investment that you think you had it when 10 years later you realize you didn't, but it's already too late. All right? No counterparty risk. That's what makes it vastly superior. And I should have one more last slide, which is conclusion. All investment analysis. I showed you so far 5 different types of analysis. Cyclical, fundamental, portfolio, behavior, and technical. Suggest that gold is now, meaning within the current time frame and within the intermediate future, an excellent long-term investment. That one is clear. Now, if you're just going to be having a diversified portfolio, 5 to 10% in gold is okay. Now, if you want to have a more balanced portfolio in the current inflationary environment, 10 to 15 is okay. If you want to construct an aggressive portfolio, definitely 20 to 40%. If you are expecting a crisis and you're really afraid financial currencies and all sorts of problems, you'd better have 50 to 80%. I am somewhere in the, personally, my own portfolio is 50% gold, all bullion, no other counterparties and liabilities, and I don't own any bond, any share in any other financial assets. But it's personally me. Again, everybody decides how they want to balance it. All right, so thank you for your time. And let's still open for more questions, or you organizers, how you want to do that.
Thank you, Professor. You surely were off the chart and outperformed your time. But we have a break coming up.